One of the top global issues being discussed at the 2025 spring meetings right now is that of climate change and, by extension, how to mobilize the necessary capital to support the emerging markets economies. Earlier today, the Atlantic Council holds a panel of discussants on the sidelines of the World Bank and the IMF meetings to drill down into a new research that could be a game changer in climate financing.
I think there are really four reasons why we think guarantees are so critical to mobilizing private investment. The first, you said, is guarantees address the real problem that financial institutions have in investing in emerging markets, and that is dealing with the risk of the investment. The risk may be perceived and not real, but they're not investing because of that. That's why their numbers are so low in this. It's not they don't have the capital, but they want to know that they can protect that capital with some sort of guarantees. The second is that guarantees provide, we think, the most effective way of leveraging government money. To get to the scale we need on guarantees, which is trillions of dollars, you're going to need some government money to go into the guarantee fund to make sure that there's adequate capital there. And in a guarantee, you've really got to put in cash and the amount of money that covers the expected risk of the facility. So, for example, on an energy project, if you think there's a 10% risk, you've got to put in only 10% of the amount of the guarantee you're doing. You need backup balance sheet guarantees, but the amount of cash going in is relatively reasonable. So it enables you to take this limited government funds and leverage them to the maximum extent possible. The third is we think we can set up very efficient guarantee facilities. For a private company to invest in a project, it has to be a simple, efficient way, a process to do that. So we've tried to, I won't go into details now in the proposals we're working, come up with something that's very efficient, that works very well for investors, that only requires one level of due diligence. Right now in doing projects, you can have up to 3 levels of due diligence, one from the guarantor, one from the host country, and one from the company doing that. That's too bureaucratic and too slow. And finally, I used to say, we would not require backup country guarantees. Right now, most guarantee programs require backup country guarantees. I would strengthen that in saying you can't have backup country guarantees, because when you start getting to the level of trillions of dollars, developing world and emerging market countries can't do that because they pick up debt whenever they do that, and they can't afford that kind of debt. So if we set up the right kind of guarantee facility from developed countries, then in fact we can say we don't want backup country guarantees, and we can structure it so that the developed countries realize that, and they're taking the risk on that. But they've committed a very large amount of money in the Paris Climate Agreement process, and arguably this is the most efficient way for them to use their money.
Yeah, you talked about debt in developing countries. I was looking at the statistics before coming here yesterday, that the cost of servicing debt in the low-income developing countries has quadrupled in the past decade. And just in 2023, the external debt servicing reached around $1.4 trillion for these economies, which is a magnificent sum. And as we said, these countries cannot afford to have a guarantee on their balance sheet as well. Mahesh, what are your thoughts on guarantees role in mobilizing private capital?
I agree with Ken that guarantees are a very important construct. And in fact, if you go back to the original foundation of the World Bank and IMF at the Bretton Woods Committee, Bretton Woods Conference, the Lord Keynes' idea was to actually create a guarantor, not a lender. But somehow the institutions have become lenders, not guarantors. The capacity of the World Bank and other development banks to guarantee has been grossly underutilized. And it's simply because their guarantees are really a mess. They guarantee partly this, partly that, and partly something else. And so the investor has to look very carefully at what it is that is guaranteed, and mostly it's not guaranteed. Whereas we think that what you have to do is to take the market concept of a full wrap, which is 100% guarantee of principal and interest on time. If you do that, investors say, fine, thank you very much. In 30 seconds, you have sold the deal. And you can get trillions of dollars of funding. In fact, the guarantee industry provided $3 trillion of funding in the markets without a loss in the US before the financial crisis. Today, it's a $500 billion industry, even with the financial losses that they took in the great financial crisis. So we want to create a guarantee company like that in the emerging markets with a full wrap, as Ajay Banga says, it is the kind of a guarantee that he calls a rating agency wrapper. So you don't ask questions, you just put a blue ribbon around it, around the deal, and away you go. The guarantor worries about the risk because he has to really do diligence in advance to make sure that the risks are really takeable and that they are well protected for their own standpoint.
Right. So you said that you are working on such guarantee mechanisms. I understand you are working on an initiative called Climate Finance Company, or CFC. Can you provide some brief introduction about the company, what it's trying to accomplish?
By all means. What we want to do is to provide a full wrap guarantee for principal and interest, ensuring timely payment to the investors. These guarantees would elevate the credit rating of the viable climate deals to single A level, where international investor demand is strongest. So in doing so, we make a much wider investor base accessible to the climate-related projects.
Ken, you mentioned about a proposal that we are working on called Emerging Market Climate Investment Compact, or EMSIC. What was the impetus for this project, and what is the EMSIC designed to do?
Yeah, well, again, the impetus for the project was what we've been talking about. When we looked at the environment out there, in 2022, the International Finance Corporation said that they estimated that about $260 billion was spent in emerging markets on the energy transition. Mm-hmm. They also estimated, the International Energy Agency, I'm sorry, they also estimated that by 2030 you needed between 1.3 and 1.9 trillion dollars of investment, and other estimates are up to 2.3 trillion. So and for biodiversity and nature-based projects, forest projects, the estimate is you need another 800 billion. This is a year. So we felt that gap could only be filled by large institutional and private investors. And again, that the best way to get them, incentivize them to do that, was to put in place guarantees. We also looked at how complex it was to do a guarantee facility out there. And we decided to come up with something that we thought worked for investors. We had to do something that investors were comfortable with in doing their work. So what we decided was that in EMSIC, we would pre-qualify an investment firm, let's say a Goldman Sachs. We look at them and say, you're qualified for our guarantees. We'll audit what you do, but we won't do double due diligence on it. And again, we thought, an institution like Goldman can do a perfectly good job of that if we do it. We would set standards for them on environment, on social equity, on just transition. But then we'd say, basically go out and do the transaction. And there are other elements of it, but that's the prime element of it. We wanted them to do a portfolio of projects, for example. So again, we thought if we came up with an innovative, new, large-scale facility, the other thing that pushed us to do that is there are a lot of guarantee funds out there, and they're all very good, and everything is very important, including the work from the World Bank, but none of them get anywhere near the scale that's needed. So our proposal was a facility that would guarantee over 10 years between $100 and $500 billion. And that seems like a large number. When you break it down, if you assume, for example, a 10% loss rate, that means if you did $10 to $50 billion a year in guarantees, you'd have to put up between $1 and $5 billion a year. And if you had 10 countries putting in the money, they'd have to put in between 100 million and 500 million each. That's not a low number, but we thought it was a doable number, particularly in light of the fact that the developed world at the last COP agreed to put in 300 billion a year into investments in these companies, including private investment. And there's no roadmap for it. There's no description of what they're going to do. And so we thought this fit in with that commitment, and this was the time to get it included in that.
Right. Besides the scales that mentioned, Ken, what are some of the other distinguishing characteristics of EMSIC compared to other guarantee proposals out there?
Well, there are two distinguishing factors. One, we think, is how efficient the facility is. In other words, by coming up with a facility that doesn't require double due diligence, it's very, very effective and really attracts institutional investors because of that, because they can feel comfortable doing that. And the second thing is almost all facilities now require backup country guarantees, and we would not require that. But the scale is an important part of it, and what we're doing, a lot of these are privately funded guarantee facilities, or in the case of the World Bank, the money is split among many different things, including environment and climate change. In this one, because we're bringing in government funding, we think we can get the level of funding we need to really scale the project up.
Interesting. Mahesh, when it comes to CFC, what kind of investors are likely to support the climate finance company? In MSEC's proposal, we are looking at sovereigns, sovereign wealth funds, governments, foundations to provide the funds for the guarantee facility. But how about CFC's model?
Well, I think all of those, but I think we would also focus a lot more on the private sector investors. We'd like to bring in insurance companies, pension funds from the private sector, and of course development banks and sovereign wealth funds. We are in the process of raising capital. We're talking to the MDBs themselves. I used to work at an insurance company of the kind that we want to set up for a decade, and I set up a company like that in Asia with the ADB. But we had 17 investors in that company, which included Government of Singapore Investment Corporation, ADB, ourselves as the private sector and the manager. We had Employee Provident Fund of Malaysia. We had Nomura Securities, Bangkok Bank, and we had AIG before it became defunct. It was AAA then. So we had an insurance, we had a public-private partnership. I think that's what it needs to be because this is the area of infrastructure and climate finance is invested with risks that are public and private together. So you need to have a partnership in the investor pool.
Right. Go ahead, Ken.
Yeah, I want to emphasize that the facility we're proposing is a scaled facility, but it's not the end. I mean, we need everybody who can to do similar facilities. What Mahesh is doing sounds fantastic also. So, this is an all-in process. We need every guarantee facility we can. We need every grant we can get. We need green bonds. To get to this couple of $1 trillion a year, you've got to do a lot of different things. And we think the guarantees that we're proposing could be very, very helpful, but the guarantees Mahesh is proposing are also very critical. So we need everything if we're going to succeed in this effort. We're really trying to rebuild and replace a key element of the world economy. And that's a massive, awesome task. And so a lot is needed to do it.
I think Ken is exactly right. In the insurance industry, in the guarantee industry, you basically, the guarantors are a club. They insure, the primary guarantor insures, and then he reinsures with a secondary, with a reinsurer. So you can lay off your risk and manage your portfolio of risk. So it is necessary to have other guarantors who will take some risks that you cannot because you have limits. And so others have the same needs. So having a large set of guarantors is a good idea, but they need to all work efficiently. Yes. And I think the advantage of the private sector experience in this is that our guarantees are timely pay, full payout. And so it's not partial risk this and partial risk that, which is what the World Bank does. That's necessary too in some cases. Indeed. But I think that's not the scalable product. The scalable product is what we are talking about because it's simple for the investor to make a decision in 30 seconds.